Hello again, Singapore. After reviewing the replay of tonight's live session, I personally felt that the video quality was not up to my standard. But I always believe every mistake is an opportunity for us to improve and come back stronger. What matters is that we recognize what went wrong, make the necessary adjustments, and do better each time. I really appreciate your understanding and patience. So I have prepared another version of previous live session for everyone. Once again, welcome to Millennium Week. Tonight, we are not just talking about stocks. We are talking about who are we actually up against. Most people enter the market from the wrong angle. They ask, what stock should I buy? Where's the next breakout? What is moving tonight? But before strategy, we need to understand the environment. Every click enters a market with different players, resources, information access, and execution power. Before we talk about institutions, let's first look at ourselves. If you trade or watch US stocks at night after work, I believe many of you know this feeling all too well. By 9:30 p.m. you have already gone through work, stress, messages, meetings, and countless decisions. Then the US market opens, candles start moving, headlines come in, and suddenly your tired mind feels like it must make decision immediately. That is where the retail disadvantage begins. Not because retail investors are not smart, but because tired judgment can become emotional decision making. That brings us to the information circle. Let's change the biggest myth in trading, the lone wolf. You really think sitting alone in your room, staring at 3 monitors with a cup of coffee is enough to beat the Wall Street? But sitting alone with charts is not enough. Strong decisions are rarely made in isolation. Access precedes analysis. We cannot analyze an opportunity we never get to see. Your information circle decides what reaches you and how early. A wider circle means wider access, deeper understanding, and better decisions. Many retail investors think the answer is to study harder, learn more indicators, watch more videos, read more headlines. But the real issue is not only effort. The real issue is input quality. If input is late, noisy, and emotional, then the analysis can also become late, noisy, and emotional. This does not mean we blindly follow people. That is another mistake. It means the quality of our information environment matters. If our only input is social media excitement, public headlines, and late night group chat messages, our analysis is already limited before it begins. Two investors can be equally smart, but if one sees only public noise while the other hears structured views, their decisions not be the same. The difference is not IQ. The difference is environment. By the time everyone is talking about the same stock, the early move may already be gone. Retail noise often arrives late because excitement spreads after price has already moved. A stock goes up first, then screenshots appear, then group chats become loud, then everyone repeats the same ticker. By the time the story feels obvious, the market may already have rewarded the people who positioned earlier. That is why popularity is not the same as opportunity. A stock can be popular and still be late. A move can look strong and still be dangerous. A headline can feel important and still be fully priced in. The strong investor asks, where did this information start? Who moved first? What has already been priced in? I am still early, or I am becoming liquidity for someone who entered before me. FOMO, which means fear of missing out, may feel emotional, but its cost is mathematical. When you chase, it affects your entry price, stop loss distance, risk exposure, and even your ability to stay calm. Let's say you see a stock breaking out. You are tired, the headline looks strong, and the chat is moving fast. And you click buy at $100. But because of spread, slippage, and thin liquidity, your actual fill becomes $102. Now, imagine another participant bought earlier at $97 before the crowd rushed in. Same stock, same chart, and same ticker, but the result is different because the entry structure is different. When stock reach $105, you feel happy, but the participant who entered at $97 has a wider cushion, better risk reward, and less stress. This is the retail tax. The market does not send an invoice, but the cost is real. That is why patience is not weakness. Patience is a position. Many people misunderstand patience. They think patience means holding a losing position and hoping it comes back. That is not a patience. That is emotional attachment. Real patience means waiting for an asymmetric setup, when reward clearly outweighs the risk. Sometimes the strongest action is no action. Sometimes the best trade is the one you do not take. Sometimes protecting your mental bandwidth is more important than forcing another entry. Think like a sniper. Sniper does not shoot because something is moving. A sniper waits for the right target, right angle, and the right moment. In the market, that means better access, better context, better risk reward, and better execution. The goal is not to be active. The goal is to be effective. This was Coach Thomas' first conviction on stage at JP Morgan conference in New York last year. Public information is available to everyone. If everyone can see the same headline and react at the same time, the question becomes, who understands the context better and who can execute better? Access beats information because access gives context. Context tells us whether a headline is early or late. Context tells us whether a move is supported by real capital or only market excitement. Context helps us separate signal from noise. Professional networks matter because they challenge our assumptions. They help us to see the blind spots. They allow us to compare one view against another before we risk capital. For retail investors, the upgrade is not simply receiving more messages. The upgrade is better quality input processed through a disciplined framework. The edge lives where the crowds cannot see. The keynote speech you see on YouTube is only the public half. The real context often happens after the official presentation ends. It happens at the round table. It happens in smaller discussions. It happens when experienced investors compare what they are seeing, what they are avoiding, and what they are preparing for. When you're outside the room, you see the final headline. When you are closer to the room, you hear the questions behind the headline. That difference changes how you prepare. This does not guarantee profits. Nothing in the markets guarantees profit, but it can improve the quality of decision making. And in the markets, preparation is everything. Be in the room with the right people. Real access is not just about more information, about sitting in the right room with right people at the right level of thinking. The wrong room makes you emotional. Everyone is chasing, everyone is shouting tickers, everyone wants fast answers. In that environment, even a disciplined person can become reactive. The right room slows the mind down. It forces better questions. It brings together people who understand the market is not only about one stock, one candle, or one headline. Asia runs through Singapore, and we placing members one seat away from institutional grade dialogue. Your circle can raise your standards, or it can pull you back into old habits. If your circle only talks about daily price swings, you are trapped inside a short-term noise. Inside the right room, your thinking becomes sharper. From New York to Seoul, institutional finance is moving on-chain and across borders. Discussed on stage, most retail investors never reach. These are not places where people casually shout stock names. These are places where capital, policy, technology, liquidity, and market structure are discussed seriously. Being close to these rooms helps you hear the shift early before it becomes a headline. This preparation, if you hear the serious conversation earlier, you have more time to study, evaluate, and wait for confirmation. Most retail investors meet this story at the final stage. The article is published, the chart has moved, the group chat gets excited. Institutional thinking tries to meet the story earlier. Conferences and closed forums where the relationship and information really move long before the retail crowd catches on. But understand this properly. The point is not to worship access. The point is to understand why access changes decision quality. When serious investors sit together, they are not only asking what is going up tonight. They compare frameworks, they question assumptions, they discuss risks. They share what they are seeing across different markets and sectors. This kind of environment upgrades thinking. When we sit alone too long, our own bias becomes the loudest voice. In the right circle, our ideas get tested before the market tests them. Now, let's move to execution. Before the US market opens at 9:30 p.m. Singapore time, liquidity is often thinner and bid-ask spreads can be wider. Many retail traders pay hidden costs without realizing it. The price you see on screen is not always the price you get. Between the quotes and the actual field, there can be spread, slippage, and weaker execution. Institutions care about structure. They do not only ask whether a stock is good, they ask how to enter, when to enter, how much liquidity is available, and what costs they are paying. For retail traders, this is a major mindset shift. Stop thinking only about direction. Start thinking about entry quality. Every click has a cost. Weak execution is a hidden cost. Larry Harris' book, Trading and Exchanges, reminds us that the market is not just a chart. It is a structure. There are buyers, sellers, spreads, liquidity providers, order flow, execution venues, and participants with different objectives. Retail order flow often provides liquidity to larger players. That sentence is powerful. When we rush in emotionally, we may be helping someone else exit, reduce risk, or complete a larger plan. Institutions position earlier and access deeper liquidity. Their advantage starts with preparation before the crowd reacts. Let me give you an example. Think of buying a Rolex. The retail trader walks into the boutique, pays the full retail price, and waits for 6 months. But institutional insider walks through the back door, gets a better price, and walks out immediately. The watch is the same. The difference is access. Same assets, different access, different cost, and different result. Coach Thomas will be outstation on Thursday and Friday for a final round of discussions with our institutional partners, finalizing the institutional access initiative for next week. While Coach Thomas is away, Coach Jason will lead the next 2 sessions: the decision-making engine and the institutional execution cost advantage. Tonight, I'm here to tear down the illusions. I'm here to show you the metrics. But showing you the problem is only the half of the battle. The other half is giving you the weapon to fix it. Stop trading like a lone wolf. Move closer to the circle. This Saturday, we are hosting a private gathering for our veteran members. There is not a public seminar. This is a closed-door roundtable. Seats are strictly limited to protect the quality of network. The guest list is being finalized this week. If you are serious about upgrading your environment, WhatsApp Jason right now to secure your seat. Do not let another week pass providing liquidity to institutions. Make your choice. I will see you on the inside.